Good morning and welcome to today's Tuesday Market Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at OptionsPlay, and today I am going to be giving you my thoughts and analysis on the current market. Now, I do apologize if there's any background noise. There is some construction going outside, but hopefully it should not be too bad. Okay, so before we get started, just our usual disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by OptionsPlay or a solicitation or an offer to buy or sell any securities. This video was not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today, going over the major equity indices, we have seen a significant pullback, especially last week. We saw volatility inch higher, and equities did decline quite rapidly over a few days, but already to start off the week, we are in a bit more of an optimistic mood here. So we'll see the price action there and discuss that a bit further. From there, we'll be moving on to fixed income and commodities. We'll take a look at the sector rotational model, highlighting which sectors are outperforming and underperforming the overall market. We'll take a look at some subsectors of interest that I have for you today, and we'll end today's webinar with some bullish and bearish market observations. So starting off here with the S&P 500 using the SPY ETF, we can see that pullback that we spoke about here, especially last week, it looked like it was starting to gather some bearish momentum. However, to kick off the week, we actually had a bounce on Friday later in the day, and yesterday we also had some bullish price action with price closing just shy of 440. So it didn't quite get down here to this previous swing level, which I was originally anticipating, given the fact that it broke below the 55-day EMA. But we are seeing that bullish price action in and around that level, with price set to open higher this morning. We also have the 444 resistance level to be looking out for. This is a minor level of resistance. It's not a major level. It acted as resistance ahead of the recent earnings season, which we eventually saw an upside break. So let's see how price reacts to that level, to 444. If there's bearish price action, we could be in store for some maybe neutral range-bound market conditions for the S&P 500. But if we see a breakout, that does open the door back towards the mid-450s for the SPY. From a fundamental and macro perspective, it's more the bearish price action that we've seen isn't really due to earnings, or it isn't really due to anything that's happening in the US as much. This is more to do with the fact that the Chinese data is looking weak, the economy isn't looking too great. We know that People's Bank of China has introduced stimulus and obviously slashed interest rates to help stimulate the economy, but overall the picture is still a little bit negative, and there's always going to be fears of contagion, especially when you consider the fact that China is the second largest economy in the world, and they account for a significant chunk of global demand. So for that reason, we are seeing what's happening in China impact equities globally, but this isn't necessarily something that's happening in the US. And the US economy is still looking pretty good. Consumer spending showing signs of deteriorating momentum, which is to be expected in a higher interest rate environment at the end of the day. I mean, the fact that consumer spending was as high as it has been in the last few months is incredible in itself. But we are now seeing a slight deterioration, especially after these earnings announcements. The forward guidance for them a lot of the time did point to deteriorating consumer spending, but nothing to be too concerned of. Forward looking, we are looking at the next few Fed meetings. The next two Fed meetings are in September and November. We should see interest rates be kept as they are. However, in December, that's the big question mark as to whether we'll keep interest rates level or whether we will actually see an interest rate cut. All of that is pretty much dependent on the inflation and jobs data that will be coming out. But if you look at the data that has been coming out in the last month or so, it has been coming out better than expected. So we could, if that trend continues, we could see an interest rate cut in December as opposed to January. And when I'm looking at the Fed futures, the probability of an interest rate cut in December is slowly increasing day by day. Okay. So moving on to the NASDAQ 100. Nasdaq 100 breaking below its 55-day EMA and now breaking back above it with price set to open a little bit higher this morning. But like the S&P, it is at a key area of resistance near 370. So we'll have to see how price reacts at that area. So even though we are seeing this bullish price action for both the S&P and the Nasdaq, it doesn't necessarily give me the green light that we'll see a rally back to the previous swing high, because there are minor resistance levels along the way. And in this case, for the Nasdaq 100, that'll be the 370 level. Remember, the Nasdaq 100 is a lot more exposed to technology names and will therefore be a bit more sensitive to any data that comes out regarding interest rates. But for now, we are seeing very similar price action to that of the S&P 500. So not too much to discuss about the Nasdaq 100 today. You have your key areas of support at 350. Price didn't quite get there, but again, all eyes will be on this 370 area of resistance. Moving on to IWM, which is the Russell 2000 ETF. So we're looking at small caps here, and the major level to be looking at is 200. Not only is it a strong psychological level, but on the weekly time frame, we have seen price unable to actually break above that area. And right now, what we're seeing is price breaking below 188 level, which is the level that we've spoken about quite a lot, because that's a 38.2 fib area that provided a major area of resistance. So since price has broken below that level, it wasn't really oversold, but maybe a little bit overextended. We saw some bullish price action on Friday, and price set to open a little bit higher this morning. But we didn't see the same bullish price action like we did for the S&P and the Nasdaq with IWM, because that just simply indicates that price or small caps are underperforming large cap names in this environment. So I don't believe that in terms of having a bullish outlook, small caps will rise with large caps. But what you want to see is outperformance, because that gives you a reason to rotate into small caps as opposed to large caps. And right now, we're not really seeing that. So even if we have a bullish view longer term, you'd want to maybe focus more on the large cap names or the large cap indices like the S&P and the Nasdaq, because we are seeing that outperformance. In terms of key levels, 188 could be a key resistance level. But in terms of the downside, I'm looking at 180 as that next key area of support. Price hasn't quite got there yet. And for that reason, it makes me believe that we could be in store for potentially another leg lower back towards 180 before any potential for a bounce back to retest that 188 area. Either way, my opinion here for small caps is that they're underperforming large cap names. And for bullish opportunities, you may be better served looking at the large cap indices. Moving on to TLT, and we've had some pretty significant price action here, with price now finally at this key level at 92. This is a major swing level for TLT, and price is approaching this level with a lot of bearish momentum. Momentum has been pretty much oversold quite some time. And I would define oversold when the 50-period CCI, which is this blue histogram, is at minus 200. That's when we tend to see a high probability of a reversal or a retracement higher, at least. And we've seen that 50-period CCI has been near that level for quite some time. So from a risk reward perspective, there's definitely potential for a bounce, but the question is that bounce going to be a trend reversal and we see price continue back towards maybe 97, which is the next key area of resistance? Or is price going to maybe respect this level like it did with the $100 level and not really move that much higher? So I think we'll have to wait and see. Even though we're seeing a lot of bearish price action, I wouldn't go bearish on TLT just yet due to the fact that it is a little bit overextended to the downside. And you'd want to maybe sell into rallies. So looking for that retracement higher, bearish price action, for a better risk reward downside entry point. Moving on to the US dollar, we can see here that price is now at this 103.50 level. This is an area of resistance that we've pointed out for the last couple of weeks. But last week when we spoke, it looked like price was about to break out of that level. And that actually hasn't quite happened. This week, we've seen price actually stall near this level, but multiple intraday bounces above 103. So this, even though price is respecting this as resistance, there is no clear evidence to say that there's a trend reversal at this point. We can see price is reluctant to move even below 103 here, and is hugging this 103 resistance, 103.50 resistance level. So in my opinion, we could be in store for potential breakout and continuation to 104.50 if this continues. But again, we'll have to wait and see. This is a lot of ambiguous price action here. From a fundamental perspective, we are seeing a lot of rotation back into the US dollar, despite a more dovish outlook for the US dollar. In terms of looking forward, the rotation is simply due to the fact that there are still some concerns about China, about Chinese data that's coming out, and therefore investors are going to be rotating towards the safer haven currency, which is the US dollar. Taking a look at gold. So gold does move inversely to the US dollar, and with the dollar actually just being quite neutral in the last week, we've actually seen gold manage to hold this area at 175 again over the last week or so, with price set to open a little bit higher this morning. I still have a bearish outlook for gold. Looking at the bigger picture, you can see that price is showing signs of capitulation with a lower high posted quite recently. And to the downside, we are seeing maybe that this bearish run is a little bit overextended. You'd have to wait for a bit of a retracement before looking for another bearish entry point. But we do have this area at 177, 175, which is a support level. And even if we get a retracement higher, price still has to break below 175 to give us an evidence that 171, 170 would be on the cards. And it hasn't quite done that. It looked like it was going to do it towards the end of last week, but it's actually, so far, price has been holding up above that level. So for that reason, even though I'm bearish here on gold, you'd want to wait until a retracement higher before a bearish entry point, or you simply want to see a breakdown and a close below 175 to play that breakdown back towards the low 170s. Taking a look at oil, looking at light crude oil futures, what we're seeing here is bearish price action at 83. And normally that shouldn't be surprising because this is a major level of resistance. But over the last few weeks, we identified 83 as our upside target when price broke out above 74, came back to retest it, and moved all the way higher back towards, let's say, 82 maybe. And 82, the price action here wasn't that bearish, in my opinion. We didn't see signs of the trend reversal, maybe one or two bearish days, but overall, it looked like price was going to be breaking out and it was heading higher. But since then, it's been a bit of a, I would say, I don't want to say a false breakout because it's still very much within the range of resistance, as you can see in the weekly time frame. But we are seeing, signs of a reversal lower. We are seeing signs of deteriorating momentum. And even the last couple of days of price action, that's been quite bearish in my opinion, because we saw a bit of a recovery towards the end of last week, but yesterday price rejecting 82 and moving lower this morning as well. So that is a bit more obvious price action, a bearish price action, as opposed to what we've had the last couple of weeks, which in my opinion was quite ambiguous, very tricky to trade. But with oil, we are seeing a bearish price action here, and we could see from here continuation lower. When it comes to oil, you want to look at the fundamentals as well. On the demand side, well, we have a lack of supply, let's put it that way. Oil-producing countries are cutting down supply to keep price elevated. And on the other side, we have deteriorating Chinese economy, leading to lower demand for oil, and that is going to always act as a headwind for price. So that's the tug of war that's happening. And difficult to say which way oil will go. So that's why we're a bit more focused on the technicals and the price action, because even though we are seeing the bearish price action, there is still minor support at that level. So if it breaks down below there, that does open the door for 74. But right now, I'm not too convinced with oil in terms of having a clear directional view. Taking a look at sector rotation, we have 7 sectors in the improving and leading category, 4 in the lagging and weakening category. So in the leading category, we have discretionary, actually weakening quite significantly last week. It will head into the weakening category here. from the leading category, in my opinion. And it has been in the leading category for quite some time, but we are just seeing some weakness within the sector and some outward rotation and rotation into the other sectors. Speaking of weakening sectors, technology is still continuing to weaken. We're actually seeing some signs in the semiconductor space that may lead to at least a short-term bounce for technology. Technology has been in the leading category for quite some time. So we are seeing naturally a rotation out of technology as well. Communications, not too much to talk about. Not too much outward rotation, but not that much inward rotation either. Pretty much staying put in the weakening category. In the improving category, we have energy continuing to find momentum. Even though oil prices have declined, the major indices have declined as well. And energy is still holding up for now. But keep in mind that this is a weekly chart and there is a lagging component to it. So therefore, I wouldn't say energy is outright a bullish sector to be in right now, as oil could potentially break down below the minor support level that we spoke about a couple of minutes ago. Financials managing to still keep going, heading towards the leading category, as well as industrials, losing out on some momentum just before rotating into this leading category. So we'll see how this week plays out, but we could see maybe industrials touch the leading category, but on its way down. Materials and real estate also finding some momentum and relative strength. And surprisingly, healthcare as well, finding some momentum, along with its other defensive counterparts, which are utilities and staples, which are also, these two are in the lagging category. So even though defensive sectors, we are seeing a pickup in terms of relative performance against, let's say, the names of technology, discretionary, communications, I think there's better places to be investing in, at least in the short term, outside of defense and into maybe financials, even industrials and materials. These are the sectors that are a bit more further in the improving category. So the subsector of interest that I have for you today, it's really the one from last week, and that is the semiconductor ETF. So last week, I had a bullish view here on semiconductors because I saw that big bullish candle, and I was looking for a potential credit spread opportunity, not necessarily playing on a breakout above 160, but a potential rally back to that level. I did identify 144 as support, and if price breaks below that 144 level, that's when you want to close the trade. But what happened last week was we actually saw throughout the week a continued decline back towards 144 and finally some bullish price action. So that 144 level still held its support, but I would say it was probably 1 week too early with its trade, given the fact that we initially saw that very bullish engulfing candle. But still, our trade remains intact. Our thesis remains intact, I should say. Price hit to open high this morning, and we're pretty much near break even. So, so far, so good, despite last week's bearish performance. Moving on to some ideas for trade or market observations for this week, we have BMY. BMY is a new one again, but I know that this is a name that we've kind of traded over the last few months, really, ever since price broke below that 66 area. It was a name that provided multiple bearish entry points, and it was probably one of the better performing trades or trade ideas that we've had this year so far. And it did reach our $60 target level. Price did manage to bounce up a little bit here, and it's back at this area between the 21 and 55-day EMA. We have 63 as a previous area of minor support that price is already struggling to break above, and I think this provides a very good risk to reward bearish credit spread opportunity here, selling a call credit spread. I'm not necessarily dependent on price breaking below 60, but what I am dependent on here is that 63 level of resistance holding, and that is critical for the strategy. And so far, it seems to be holding. The overall trend here is still bearish. It just has a major level of support at that $60. So for that reason, a bearish credit spread can take advantage of the bearish to neutral price action, as long as it stays below 63. Looking at Johnson & Johnson, this is a name or the trade idea that we've had for the last couple of weeks. And a lot of patience was required for this one because we were looking at all these multiple rejections above 174. And finally, we have seen the bearish move that we were looking for the last couple of weeks. Price did gap down all the way to close near that 167 area yesterday, and not actually opening that much higher, unlike the rest of the market. So maybe there is still some additional weakness here, and we could see a continuation lower. But either way, the move was quite significant, and I wouldn't blame you if you wanted to take profits. At least definitely taking partial profits at the open would make sense. Letting the rest of the trade run. If it closes above 168, maybe close the rest of the trade for a very good profit. But if it closes below 168, or sorry, 167 or so, it might make sense to continue to let the trade run for a bit longer. Taking a look at JP Morgan, this is a newer idea for today. JP Morgan, it has been on my radar for quite some time, ever since price broke above 144. But this rally was a little bit overextended to find good buying entry points. However, in the last few weeks, we've seen price break below its 21-day EMA and finding support at 147.50, previous swing level as well, and also near the 55-day EMA here. Set to open a little bit higher this morning. This provides a good risk to reward bullish entry point for continuation higher, targeting 157 as a first take profit zone and potentially even 170 as a secondary take profit. Maybe a bit more for longer term play there. But either way, I'm looking at more of a debit spread opportunity. I do want to take advantage of what could potentially be a strong move to the upside. Moving on to Oracle, another old idea that we've had. Oracle has been a reliable credit spread, a bullish credit spread, with 114 so far holding as support. There was a bit of a scale last week with price breaking below that initially, but managing to break back above it after finding support at that 55-day EMA. And so far, our thesis holds intact. I would like to see a continuation higher here, but we're not really getting that. But if you take a look at the overall relative performance against the broader market, at a time where equities have been declining quite rapidly, especially last week, Oracle has actually managed to hold its ground and stay above 144. So that relative performance is what you're looking for bullish opportunities. But that being said, there isn't a huge amount of upside momentum here. So a bullish credit spread would probably be your ideal strategy of choice, in my opinion. Right, taking a look at Roku. So Roku, a bullish idea from last week. Reason I went for Roku was because we saw a strong breakout followed by a nice pullback towards the previous area of resistance, looking like it was turning support. It hasn't been invalidated, but we haven't seen the immediate bounce that we were hoping for. So this trade still stands, but again, we'll have to keep a close eye on this over the next week or so. If it doesn't make a significant move to the upside, I would probably just look to close it out near a break-even price just to limit potential losses. Because this was more of a debit spread opportunity, because I was looking for, again, a strong move to the upside. And even though it hasn't necessarily invalidated that thesis, there's just a lack of momentum here at this level. So with that is all I have for you today. Thank you so much for joining me, and I hope to see you all next week, Tuesday, for another Markets Outlook webinar. Goodbye, everyone.